Hey guys, so today we are going to get into understanding the key parts of the option, not the option chain, but of a option. Okay, you have the option chain where you see all these things like your volume, you see the implied volatility, you see your delta and theta. I want to go up a little bit and give you guys a full understanding and the key parts of the option itself, because understanding these key parts is what helps you select the proper option for your trade or the proper strike for your trade. Okay, so this is a super beginner lesson, and we're going to start from the very beginning, and that is just simply understanding the underlying asset. Now, the underlying asset is exactly what it says. It's the asset that you're looking to trade. That could be Apple, that could be Tesla, that could be Uber, that could be Beyond Meats, it could be Sofi. Whatever the stock is, that stock is considered the asset, or you may hear it referred to as the underlying asset that you are looking to trade. Once you pick that particular asset, you will be able to, depend on the platform that you're using, you'll see somewhere to trade, you'll see somewhere to take you to the option chain, and that is where you will begin to see additional details about that particular asset, right? You'll be able to see the strike prices and all of that premium. And the premium is the cost that you will pay to be able to enter that trade. Now, you go to the option chain, right? Whether Webull, Moomoo, Robinhood, whatever you may be trading. One of the biggest questions that I'm asked is, why am I seeing 5 cents, 15 cents, $1.20? But when I'm ready to buy my option, it hops up to $150. It may hop to 15, maybe it hops to 50. That is because the premium cost is 100 shares. Okay, so if you see 15 cents for that particular strike, or the premium is 15 cents, and you go to check out and you see $15, that is because that 15 cents is times 100 shares. One option contract is a total of 100 shares. Okay, so if you were to select 2 contracts thinking you're going to pay 30 cents for 2 contracts, no, you're going to pay $30, because now if you put 2 in that contract selection of how many you want, it will double. So it will go from 100 shares to 200 shares, and it's going to multiply that time the price of the strike, which will be the premium. And the premium is just the price that you're paying to be able to access and hold this trade. So this is just simply the price that you pay up front to get into that trade. Now, if it's a losing trade, then you lose whatever you put in. You can only lose the amount of the premium that you put in. So if your premium was $250, that is the only thing that you can lose. Now, by only thing that you can lose is just saying that you will not lose more than $250. At any time, you can cut your losses and stop the trade and say, okay, I've lost $50 on this trade. I'm going to take my 200 out so I do not lose my entire premium, and I'm still in the game. I can still trade. I can find my next play because I have money left over, and I did not lose the entire premium in that losing trade. However, if it's a winning trade, you will see the value of that option go up. Or if it's gaining value, then you'll see it go up. So if that premium costs you $250, and let's just say it increases by $100, you can sell that trade or sell that option, and it will come out with $350. Okay, so you paid $250 to get into the deal, get into the trade. It went up in value. Let's say it increased to $100, and you just profited $100 off that trade. Now, really quick before we get into the next part, a lot of platforms charge a fee to actually purchase your premiums, or they'll get into your option trade, or they will charge you once you sell it. It could be different prices. It could be 1 cent, it could be 2 cents, it could be 5 cents. Each platform have their own fees for option trading. Now, let's look at the strike price. The strike price is one of those, it's an important part of it. The premium, that's important, of course, because it's just basically saying, hey, this is how much you got to pay us. But the strike price is going to be one of the most important decisions that you make when you, okay, well, one of a few most important decisions, but it would definitely be an important decision when you are looking to get into an option trade for any particular company. That strike price is your target price. If a stock is $50, okay, so just say Nike, I do Nike. Let's say Nike is $80. okay, and you say, okay, I believe that Nike is going up, and I believe that in 2 weeks it can go to $85. So you say, okay, I'm going to get a strike price for $85 because this is the target price that I have for Nike going. If the trade goes in your favor and it begins to move closer and closer to $85, the value of your option increases the closer that it gets to that $85. Now, if you've ever been on the option chain, whether you're new to it, I'm pretty sure you have probably seen if you've taken the time to actually explore option chain, is you will see that the strike prices have different premium prices. Okay. Now, let me see how can I put this in the most simple manner. If the stock is $80, okay, and I say I believe it's going to 85, you don't pick a strike that is close to that $80. You will be going what is called out of the money or referred to as OTM. The further you go away from the current price, the current strike price from the actual price of a stock, the cheaper your option will be, or the cheaper your premium will be. So if the stock is $80, and I say, okay, I believe it's going to 85, but I'm not going to pick a $85 strike. I'm going to pick something a little bit closer to the current price because I can see profits a little bit more faster. So if a stock is $80 and you believe it's going to 85, regardless of what you believe, you say, I'm going to pick a target a little bit closer to whatever the current price is. This would be a at the money or a in the money option. Now, I'm not going to put that too much in this video, but I did post a video on my YouTube you can definitely find. And I'll have a little pop up here where you can click it where I talk about in the money, at the money, and out of the money options. So you can kind of refer to that and understand what I'm talking about in this part. Okay. So the further you go away on your strike price, the cheaper your premium will be. Okay. So if the stock is $80 and you say, I believe it's going to 90, so I'm going to take a 90 strike price, you will notice that you're paying a lot cheaper for that premium than you would if you were to pick something that was the exact same price of the current stock price or lower. Now, if you pick a lower price where you say, okay, I believe Nike is going up, but I'm not going to pick a strike price that's higher than the current price. I'm going to pick a strike price that's lower than the current price because its value is already there. Okay, I hope that makes sense. So if the stock is 80 and you say, I'm going to go deep in the money and I'm going to select a $75 strike price, that means that, okay, the stock is 80, but I'm going to select the $75 strike price. That stock or that trade or option is already about $5 in value for the $85 one or 91. So these strike prices will be a lot more expensive because they already hold value. So, like I was saying, find that little pop up or go and find my video where I talk about in the money, at the money, and out of the money, also deep in the money, so that you'll kind of understand exactly what we're referring to when we're talking about those strike prices. And that kind of helps you understand why the cost of them are all so different. Now, the very last part is the expiration date. Now, I know I said the strike price is probably one of the most important, but that expiration date, especially if you are someone such as myself who likes to have time on my side with every single trade, no matter how long I'm looking to hold it, that expiration date would be the key thing that you want to pay attention to when you are entering your trades. The expiration date is when your contract expires, when that option expires, when it becomes null and void, when it will cease to exist. This is your deadline for when you have to either see profit, sell off your trade so that you can take your profit or cut your losses. That expiration date, you will probably notice that they're most of them pretty much expire on a Friday. Okay, so you have some, you have 5 days, you have 14 days, you got 30. You can get an expiration date all the way to a new year if you want to, and that is referred to lease. Basically, just saying you're holding it for a long time and you're going from one year to another. So if this is 2025 and I pick an expiration date for January 2026, that means that I can hold this trade, let it make its move up or down for an entire year. Now, it may not be exactly a year, but you can hold it into a new year, basically giving yourself a massive amount of time to let the trade play out. Now, why is the expiration crazy important? One of the most important things as a trader is allowing your trades to make its move. Now, unless you're someone who's scalping and potentially a day trade, even if I'm doing a day trade, I'm still going to have at least 2 weeks on my expiration, at least something that expires into the next week. Because even if I'm in Tesla and I say, I know the move that it's going to make, it's a slight possibility it may go against me today, but at least I know I have tomorrow. I have 3 days. I have 2 weeks to allow it to go the way that I need it to go. Okay. So that expiration gives you time to hold. It gives you time to let things play out, and you have much more time to decide on whether or not you want to stick in that trade or you want to sell it all off, especially if you have multiple contracts. So, me personally, let's just say I have 5 contracts on a trade and I got 30 days on my expiration and it's in profit. The value is there. And I said, looking at the charts, I see that we can continue going up, but I'm not going to just let this thing sit without selling something off first. That extra time on my trade allows me to sell one contract and still have 4 to keep running. Then it pushes up some more. I say, okay, I'm going to sell another one and allow the other 3 to keep going. This right here allows you to take profit as you see it. So just in case they just say a week from now, even though you may have 30 days, it start coming back down, you took profit along the way so that you didn't fully lose out. Okay. So having time in your trades is super, super important. And that is exactly what that expiration date is. All right. So those are the 4 main things. You have your underlying asset, which is the stock. Tesla, Apple, whatever company that you are looking to trade. You have your premium cost. This is the cost that you pay to enter into your trade. Then we have our strike price, which is just simply our target. Okay, that target is just where we believe that the stock will be going. And you can always pick a strike price that is lesser than the current price if you want to get one that is already a value. Just know that you will pay more. And lastly, that expiration date is just how much time you have to hold your trade and let it make its move. Even if you are a day trader, I still recommend you getting a little bit more time than just, something that expires that same week. So if it's a Monday and you see one that expires in 5 days, likely it will expire on Friday. But I still say go into the next week just in case so you can have more time and you can get a lower theta. I'm not going to do too deep into the theta, but you can definitely find where I talk about the delta and the theta on my page. Do another little pop up here so that you can understand what those things are and how they take effect within the option itself, especially on those expirations. So I hope this helped. If you are new to it, I hope this is something that kind of gives you a better understanding of those very simple components, because when you are selecting your options, you want to be sure you understand exactly what you're seeing on that option chain. Okay, so I pulled directly from here and it's a thicker. Okay, so wherever you may be watching this, you can find the link. If you're on YouTube, you can find it down below in my description or a link somewhere wherever I may post this video. Okay, and if it's anywhere where it's not a link, check the bio. All right, so I hope this helped. I will be bringing more from the book to bring some more beginner lingo, option chain, and just overall stock and market, options and stock market lesson to give it to you as simple as possible. Okay, so it's very, very important that you understand what you're reading, what you're looking at, what the terms are, so you know how to make better decision with your option. All right, so I will see you guys in the next one.